For more on Disney, let's bring in Newsweek editor-at-large Tom Rogers. He was also the former TiVo CEO and the first NBC cable president. Tom, it is always good to see you.
Thanks for having me.
Please read between the lines and tell us what you think is on page number 1 of the Bob Iger playbook at this point.
Well, first, to solve a problem, you got to admit you have one. And I've been saying for a long time here, in fact, that don't get carried away with Disney's streaming prospects. The big issue to keep your eye on is decline of the legacy business, and that could swamp any growth they get out of streaming. And I did take away from this the fact that they are putting decline of the legacy business center stage now, owning up to it in a bigger way, recognizing the problems here are truly severe. And I think with that, the solutions are possible, but he couldn't hand this off to a new CEO right now, or there wouldn't have been any point in him coming back. There's just too many things here that are a problem to hand this off to a new CEO at this point.
Tom, it's one thing to have streaming problems, but their legacy businesses have been extraordinarily challenged. And to your point, I mean, given what's there right now, there's no way he's leaving within the next few years. I mean, he's probably going to be in this job a lot longer than he thought. So this is not going to be a quick fix, I don't think, at Disney, especially when you look at their traditional businesses.
Right. Well, when you think of the list of problems, movies aren't working, cord cutting's accelerating, sub fees from cable are going negative, advertising is going negative, viewership is declining. They got a very cloudy buyout process with Hulu. Disney World was actually down last quarter. You got runaway sports rights, and that's just on the legacy side. That's before you go to streaming, and $2.5 billion of estimated losses on the streaming side this year, compared to what looked like $9 billion of positive EBITDA coming out of Netflix. Their revenue per sub with Disney Plus was down in all regions last quarter, as well with Hulu. Disney subs declined for the first time last quarter. They're trying to grow while cutting costs, and they're trying to raise price with less programming. And you put all that together, there's a lot here you got to solve. And there are two deals that are not going to be easy to do that are part of the solution, certainly not all the solution. Owning all of Hulu, which I think Comcast is going to dangle over their heads and torture them for a while with that, because it's critical to Disney being able to put together a cohesive bundle, and an ESPN deal of some kind with a strategic, which is got a lot of complication to it as well, because separating ESPN and ABC is no easy trick.
So I just stopped the stopwatch, Tom. You went on for like two and a half, 3 minutes easy, just with a list of the things that ail Disney. Tim was just saying everything is in the stock. What's your take on what is priced in, what investors have accepted, and whether or not you think Bob Iger can actually tackle all those things on that list in some meaningful way to the stock?
Well, he certainly can't tackle it in the next year and a half, so I'm not surprised at all that they put this out for, 3.5 years. Certainly, they're going to have to come to terms with this, because the media world is going to change drastically in the next 3.5 years, and Disney has to be in a position to be able to grow with it. I do want to point out, they have created, in a very short period of time, as he said, a $20 billion revenue run rate business in streaming, only second to Netflix, which is about $32 billion or so run rate revenue in streaming. So it's not as if they've got nothing. They got a lot. But against that backdrop, they got to solve these problems. It's going to take more than a year and a half to solve them. Iger's the right guy, given how well he knows his business. But nobody should think that this is going to be a fast turnaround, because it just isn't.